if you can see me or hear me.
Go ahead, Mr. Tom.
Okay, thank you very much. Appreciate the invitation. Listen, there is so much to talk about, so little time. So I'm going to go through this presentation very, very quickly. So please pay attention. Listen, I know that your clients are nervous. I know that interest rates are high. I know that inflation is still elevated. I know that the Bank of Canada is still talking about raising again. I know that the reset of mortgages is coming. And I know that clients are asking a lot of questions. But I can tell you that I see the light. I think that interest rates are peaking, and I think that they will start going down in 2024, and there is so much pent-up demand. So if you are doing okay, just okay, in this environment, you will do okay and better than okay in any other environment. At the end of the day, and I'm not saying it lightly, what the real estate market is facing now is the biggest test since the 1991 recession. The real estate market is basically in a recession. So if you're doing okay now, you will do okay in any environment. This is the time to hold your clients' hands and tell them what you see. And I will try over the next 20, 25 minutes to provide you with some lines that clients can be used to understand where we are. We don't know all the answers, but we can put things in perspective, and that's the purpose of this conversation that we are having now. Let me establish a few things. Everything is about inflation and the Bank of Canada's reaction to this inflation. At the end of the day, when you talk about inflation with clients, you have to realize and tell them that at the end of the day, it's really not about inflation. It's about the cost of bringing inflation down to 2%. 2% is the target that the Bank of Canada would like to see inflation stabilizing. They will not change that target. We can discuss until we are blue in the face to what extent 2% is the right number. I don't think it's the right number. I think it should be higher. It's not going to happen. They're going to stay with 2% for a while, which means that we are stuck with it. So they will do whatever it takes, including taking this economy into a recession in order to achieve that target. It can be 2, it can be 2.2, 2.3, close enough to 2, like 2-ish. I think that's the direction. So that's the starting point when you discuss it with clients. The second point is to realize that the Bank of Canada is very biased. Basically, the Bank of Canada is preferring a recession versus inflation. So if there is an element of overshooting, they prefer to overshoot, namely raise interest rates higher than needed in order to fight inflation. And I believe that's exactly what they're doing now. If the Bank of Canada was an AI machine, they would have stopped 50 basis points ago. So we are in a situation in which the Bank of Canada is already overshooting. And remember, there are two ways to overshoot. And that's very important to discuss with clients. One is to take interest rates higher than needed, and that's exactly what's happening now. The other is to keep them high for longer than needed. We'll discuss it in a second and see what makes sense and what doesn't. Now, I know that many of you by now are very disappointed because everybody promised you a recession, and we didn't get a recession. But I think we are in a recession. I think that if you measure it correctly, we are basically in a recession, not a deep recession, but a recession in my eyes. Let's view some of those data points that we received recently, and none of them is good, economically speaking. Let's go to the first chart. GDP growth in Canada is approaching 0. It has been 0 for the last 6 months, and it will be 0 for the third quarter. So we are basically operating at a 0% environment. This is extremely close to a recession. The next chart is telling you that we have a situation in which business confidence is already in a recessionary territory. This is a small business confidence index. Usually it's negative when there is a recession. So we are already negative. It's as bad as it was during COVID. So clearly businesses don't have any confidence. You go to the next chart and you can see that business openings are down, again, back to the recessionary period of COVID. This is another recessionary period. So clearly we have a lot of bad news coming from the economy, unfortunately reacting to higher interest rates. And clearly, unfortunately, and you know it better than anybody else, the next chart is telling you that the housing market is basically in a recession. we have a situation in which sales are down by 40% for their peak. They are 12, 13% lower than they were in 2019. So sales are down dramatically and will continue to go down, unfortunately, over the next 6 months. For the first time, we are starting to see, and you know it better than anybody else, we are starting to see supply rising, listings rising. This is a lot to do with distress sales. What was protecting prices until now was the fact that nobody was listing. Now we see this divergence between listing rising, the gray line, and sales down, which means that we are in a buyer's market with no buyers. This is where we are now. So if you want to describe the market to clients, we are approaching a buyer's market because of more listing coming, but no sales, a buyer's market with no buyers. That's more or less where we are. And we'll continue to be in this environment for the next few months. If you go to the next chart, you can see that the mortgage market is reflecting that. This is the fastest ever decline in mortgage outstanding on record. Even in 1991, mortgage outstanding fell, but less quickly. So this is a very sudden, significant decline in mortgage activity, of course, reflecting the huge, very quick increase in interest rates from basically 2% to 8% if you look at the stress test environment. So this is significant. This is the environment in which you are operating now. So this is the worst environment we have seen since the 91 recession. And therefore, again, remind yourself that this is not normal. This is not what will be the case 6 months from now, a year from now. It will be much better, but you have to go through this period in order to adjust what's happening in the housing market, because the housing market needs an adjustment. And talking about the recession, if you go to the next chart, although the official statistics are not telling you a recession, we are basically in a per capita recession. Per capita GDP growth is down by 2%. Per capita consumer spending is down by 3%. So per capita, we are in a recession. So the only reason why we didn't get a full-scale recession yet is because of the fact that we got 1.2 million people entering this country over the past year. This is not a way to grow an economy. You need to see GDP per capita rising, because just more people entering, India is also has a lot of people. That's not the way to measure economic activity. You want to measure economic activity vis-a-vis per capita GDP growth, which is now falling, and therefore, in my books, we are already in a per capita recession. Now, if you go to the next chart, you can see where we are. Inflation, despite the slowdown, is still elevated. So we have the economy toying with a recession, a per capita recession, the housing market is in a recession, and inflation is still elevated. And the question is, what's next? We all know that the last mile in any race is the most difficult one. And we are entering the last mile. And I believe that this last mile will be achieved in terms of reaching a 2% inflation rate, given where we are in the interest rates environment. Now, we have to remember that the Bank of Canada is becoming much more effective in its ability to fight inflation. Why? Let's go to the next chart very quickly to discuss. I want you to discuss this with clients because this is important. Until recently, the consumer was immune to higher interest rates in terms of consumption because the consumer was sitting on no less than $165 billion of excess savings, $165 billion of excess savings, because during COVID, we all know what happened. People got their salary, they didn't spend money, their checking accounts got larger and larger, $165 billion of excess savings. So when the Bank of Canada was raising interest rates, people were able to reduce their savings and continue to spend, and that's why the consumer was so strong. Today, that excess savings is basically zero. People are rediscovering their plastic, and credit card activity is actually going up. So you don't have this immunity anymore, which means that the Bank of Canada now is more effective because when they raise interest rates, the impact is immediate because we feel it. We don't have the buffer that was protecting us. This is very important to communicate to clients because it means that now with the effectiveness of monetary policy rising, there is no need to raise interest rates more because it's already working. You see? Let's go to the next chart and see what it means. It means that the Bank of Canada is very powerful. Look at the difference between Canada and the US. And that's why interest rates in Canada don't have to go higher than interest rates in the US, because for 1% increase by the Bank of Canada, the Fed has to raise interest rates by roughly 2% because our monetary policy is more effective. Why? For two reasons. The most important one is our mortgages are for 5 years. In the US, their mortgages are for 30 years. So when they raise interest rates, it takes forever to impact the consumer. In our case, every year, 20% renew. So we see the impact much more immediate. The other factor is, of course, debt. You go to 2008, the US went through the mother of all deleveraging, as you can see from this chart. Their debt to income ratio went down. Canada, 2008 was not our recession. We were basically second-hand smokers back then. And clearly, we had a situation in which our debt level went up. When you have more debt, you are more sensitive to higher interest rates. So what I'm telling you here is that the tiny Bank of Canada is more powerful than the mighty Fed when it comes to affecting monetary policy and impacting your clients. This is good and bad. It means that when they raise interest rates, we feel the pain, but it also means that there is no need to raise interest rates further because we are already there. Let's go to the next chart and see what it means. Although we talk about inflation a lot in Canada, the reality is that we are winning the fight against inflation better than any other G7 economy, including the US. This is again reflecting the effectiveness of monetary policy. That's extremely important. So this is the background in which we are operating. But of course, inflation is still elevated. So we need to have a narrative about inflation. So when you discuss inflation with clients, you have to say two things. First of all, it's not really about inflation, it's about the cost of bringing inflation down to 2%, but also where this inflation is heading. And I believe that many of those inflationary forces that we have seen until now are turning into disinflationary forces. Let's go one by one and discuss, and please make some notes because this is something that consumers will, or clients will benefit beyond what they read in newspapers. Let's go to the next chart. Let's start with commodities. I know that all of us are overwhelmed by how expensive food prices are. So when you discuss this, because we go to the supermarket, we are overwhelmed. We all know the story. But it's irrelevant for the Bank of Canada. Why? Because the Bank of Canada does not care about the level of prices. Let's remind ourselves and our clients that inflation is the rate of change. Inflation is not the level of prices. So although the level of prices of food is very high, what the Bank of Canada cares about is the rate of change. So if prices went up by 8% last year, and this year they are going up by only 4%, it's disinflationary, not inflationary. That's exactly what we see in energy. That's exactly what we see in food. The level is high, but the rate of change is slowing. That's positive as far as the Bank of Canada is concerned. The next disinflationary force is the next chart, and that's supply chain. Extremely important to discuss it with clients. Supply chain is back to normal. Today in the US, you have almost 20% more truck drivers than before the crisis. The going back to normal of supply chain has major disinflationary implications. Three, in fact. First of all, we have a situation in which when you have less supply chain issues, the prices of especially goods are not going up as quickly. In fact, they are going down. That's exactly what we're seeing. Second is, again, about the effectiveness of monetary policy. You see, when you had supply chain issues, 80% of inflation came from outside, from supply, which means that the Bank of Canada was impotent in its ability to deal with the situation. Believe me, Putin does not care about the fact that the Bank of Canada was raising interest rates. So we had a situation in which the Bank of Canada was unable to deal with the situation because they raised interest rates, but the inflation came from outside. Today, with supply chain back to normal, 80% of inflation is domestically driven, very sensitive to the Bank of Canada's policy. And that's extremely important because the Bank of Canada is getting even stronger and it's a strong bank to start with. And the third has to do with the next chart, which is profit margins rising. among retailers. Let's face it, many retailers were hiding behind the fog of supply chain. You went to the store, you asked for this dishwasher, and they said, listen, supply chain, China, India, Russia, but if you pay a bit more, we'll find one for you in the basement. Look at the correlation between supply chain and profit margins among retailers. Went to the sky, 97% correlation. Today, supply chain is back to normal, nowhere to hide. Things are back to normal. Therefore, profit margins are approaching zero. This is a major disinflationary force that is underrated. So another force to talk about when it comes to supply chain. So it's the effectiveness of monetary policy, it's the price mechanism, and it's retail margins. All of them are now negative, impacting inflation in the right direction, namely down. And then we have the next chart, which is very important to discuss, especially with your clients. So let's go to the next chart and discuss interest payments, real estate. What I mean by that is that how do we measure inflation in real estate, in housing? We call it shelter inflation. So the Bank of Canada and Stats Canada they don't look at the prices of houses. That's not inflation. They look at the services that the house gives you. That's how they measure inflation. So they look at rent, they look at commissions to real estate agents, but the most important item in shelter inflation is what? Mortgage interest payments that are now rising by no less than 30% a year. Mortgage interest payments. So think about it for a second and discuss it with clients, see what they say. The Bank of Canada is raising interest rates to fight inflation. Higher interest rates are adding to inflation through higher mortgage interest payments. You see, it doesn't make any sense. It's like putting a humidifier and a dehumidifier in the same room and let them go at each other. It doesn't make any sense. In addition, because of higher interest rates, as you know better than anybody else, people cannot afford buying a house, so they're renting. Rent is rising by 7%. So by its action, the Bank of Canada is raising inflation vis-a-vis rent and vis-a-vis mortgage interest payments. Nobody will be able to convince me that mortgage interest payments are inflationary. They are disinflationary. Disinflationary because they are slowing down the consumer. So that's more or less where we are. Now, just for fun, let's see where inflation will be without mortgage interest payments. Let's go to the next chart. Oh my gosh. It's basically there. It's at 2%. So what I'm telling you here is that the only reason why inflation is above its target is because of the fact that the Bank of Canada is actually raising interest rates. That's how crazy the situation is. And that's why I believe when I discuss it with the Bank of Canada, that the right measure is actually without interest payments. And there we are already achieved the target. And therefore, I believe that the Bank of Canada is already overshooting by 50 basis points. And therefore, interest rates are higher than they needed to be. Having said that, we still have to discuss one more thing. Let's go to the next chart. That's the labor market. Because at the end of the day, what's sticky is not goods prices, it's service prices. And at the end of the day, 80% of service cost is wages. So you want to have a narrative about inflation, about interest rates, about mortgage rates, you need to have a narrative about the situation in the labor market, namely wages. And I suggest that the labor market is normalizing big time. I believe that all those vacancies that people were talking about, you cannot find help, 1 million vacancies, a bit of it was a mirage because we haven't seen wages rising in any significant way, especially of low-wage individuals. Usually in economics 101, they tell you if you have a shortage of something, the relative price of this something will go up, namely the relative wage of low-wage individuals will be rising. So we look at the bottom 20, we look at the bottom 40, it was rising, but nothing to write home about. So we went to small businesses that employ 80% of those low-wage individuals, and we say, what's happening? And they say, listen, You are telling me that the recession is coming. I'm not going to raise wages 5 minutes before recession. And I say, you don't raise wages 5 minutes before recession? You don't need this person. It's easy to press a button and say, I need 5 people. Show me the money. And guess what? We are bleeding vacancies. Vacancies are falling at a rate we haven't seen before, like a stone, which means that the market is normalizing. Let me demonstrate using this chart. This chart is very important. This is the rate at which people move from one industry to another. During COVID, we have seen it going up significantly. So let me use an example to illustrate. In a normal recession, not like this recession, in a normal recession, if you were an employee, let's say for Air Canada, you lost your job, you went on employment insurance for 6 months, and after 6 months, the recession is over, you went back to Air Canada or any other airline. Today, after 3 long years, you moved on, as you can see from this chart. The rate at which people moved from one industry to another reached a record high. You moved on to a totally different occupation. So if you are in Canada, you have to start fresh, finding new people. And that's exactly what we did. They did. You look at the chart, it's back to normal. But I know it better because I took a flight from BC to Toronto. All the flight attendants were green. All of them were new. How do I know that? They were extremely nice. So I can tell you that Air Canada achieved its target. So the market is normalizing. The next chart is showing another illustration of the market stabilizing. If you go to the next chart very quickly, you can see the relationship between the unemployment rate and the job vacancy rate. The golden, the orange dots, that's before COVID. The gray is during COVID. What's interesting is that the gray is getting very close to the orange, which means that the market is already normalizing back to 2019. Another very important indicator is the next chart. And that's the quits rate, the most powerful leading indicator in the labor market. If people feel that the labor market is strong, they quit, because usually the wage that you get among quitters is higher than the wage that you get among stayers. But you can see that this wage now is back to normal in terms of the gap, which means that people are not quitting as much as they used to. So you look at the quit rate, the chart to the right, it's basically back to 2019 level. This means that the bargaining power of labor is going down. And all those strikes that you are seeing, they're all lagging indicators. They're telling you about the past, not the future. So therefore, you're the Bank of Canada, and you are looking at all those databases, data points. You look at all this information. You see a recession in the housing market. You see GDP approaching zero. You see per capita recession. And even in the labor market, you see very clear trajectories of a slowing labor market, slowing wage inflation, and a labor market that is normalizing. So what do you do as the central bank? Remember, you are very biased. You prefer a recession over inflation any day. But at the same time, you cannot just continue to raise interest rates. There is no tomorrow. So I think that the Bank of Canada is done. They are done. They have reached what we call a terminal rate at 5%. My opinion, 50 basis points too high, but let's call it done. The next question that I'm sure that your clients are asking is, when are they cutting? Remember, there is another way of overshooting by keeping interest rates higher for longer. I say May, June is a reasonable guess when the Bank of Canada will start cutting. Now, remember, the economy is in a recession. That will accelerate the process in which the Bank of Canada will start cutting. The next question is by how much? We started this saga at 175. We are at 5. We stay at 5 until May, June, maybe earlier if we are lucky. And then we cut to what? I say 3. Remember, 175, 5, 3. Why higher than before? Because before was too low. It was not healthy for anybody. Also, we have some inflationary forces cooking. We used to have globalization, now we have semi-deglobalization. That's inflationary. We used to have just-in-time inventories, now we have just-in-case inventories. That's inflationary. We used to have a labor market that was giving. Now the labor market is tighter. That's inflationary. And many of those green initiatives, let's face it, they're inflationary. For inflationary forces, the target is 2, not changing, unfortunately. So 2, we are stuck with it. More inflation coming, by definition, interest rates have to be higher. 3 to 75 is a reasonable rate. And let me remind you that your business can do extremely well, more than well, at a 3% overnight rate, Bank of Canada rate. You can do extremely well. This is actually healthy because zero interest rates were too low, creating too much damage in the housing market. So I think that the return to 3% rate is in fact good for your business. Regardless, if you go to the next chart, we know that we need interest rates to go down. Today, if you renew your mortgage, on average, your payment goes up by 20%. If you renew today and you took the mortgage in 2020, your payment is 30% higher, same goes for 21. But my focus is not if you renew now. My focus is if you renew in 2024, but more so 25, 26. I believe that over $1 trillion of mortgages will be reset over the next 3 years. That's significant. That's very significant. So we need to make sure that interest rates are down in order to absorb this shock. This is a shock. Let's go to the next question, to the next chart, and see what it means. No less than 60%, close to $1 trillion of mortgages will be reset over the next few years. We need interest rates to go down, and they will. They will. You go to the next chart, and you can see that the 5-year rate will start moving way before the Bank of Canada. I think we are very close to the peak of the 5-year rate, and it will start going down, reflecting what's happening in the US, reflecting what's happening in Canada. So that's very good. That means that the shock will not be as significant. It will be there. People will struggle, especially with the stress test, but it will not be as bad as if interest rates remain in current rates, current levels. So they will go down, they will lower the shock, but the shock will be there. There will be some distress test, distress sales. There will be some delinquency rate rising, no question about it. And over the next 6 months, unfortunately, I see the market still slowing down with more supply coming, less demand, until there are clear signs that interest rates going down. So if you go to the next chart, I think that the main casualty over the next 6 months will be the condo market. The condo market is seeing supply still rising. We see a situation in which the majority of investors are in negative cash flow. They are not buying as quickly, especially people with multiple units. And in fact, they're starting to sell. We see more supply coming to the market in the resale market. If you look at units under construction, still rising by 10%, while the low rise is in negative. So the low rise is adjusting, the high rise is still not adjusting. The only thing that is falling in the high rise, of course, is pre-sales that will impact activity 2 years from now, 3 years from now. So the current environment is actually not very constructive to the condo space over the next few months. So this is the test. That's more or less where we are. The real estate market is in recession. It's not over yet. The next few months will be challenging. However, I'm seeing the light. 2 things are happening. One is interest rates will start going down. And as we know from the January experience, when interest rates stabilize, when there is a sense that interest rates are not rising anymore, the market wakes up. That will happen soon in 2024. The 5-year rate will start going down before the overnight rate and the prime rate, and that's another positive story. And let me remind you that beyond the next 6 months, the fundamentals of this market are crazy tight. We are getting 1 million people a year into this country. The supply is not there. Clearly, we just have to go through the slowdown that we are witnessing now, but the fundamentals of this, and we need much more supply than we are over the next 6 months, and that's a very healthy adjustment. So we have to remember, at the end of the day, things are changing. Recession environment, I believe, it's not going to be very severe. It's basically a very mild recession, or if you wish, you can call it a soft landing. We are definitely in a per capita recession. Interest rates have peaked. They will start going down in 2024. And by 2025, pent-up demand will surge and you guys will be very, very busy. So just go through the next 6 months, hold your client's hands and explain that clearly what was normal in the past is not normal in the context of today's economy. I will stop here. Thank you very much for your attention.